Well, as 2018 draws to a close, market volatility has spiked and financial markets are struggling to hold on to any gains for the year. So what can we expect in 2019? Joining me is Bill Priest. He is CEO and Co-CIO for Epoch Investment Partners, and he joins me from New York. Bill, great to have you with us as this is our final show for the year, so we can talk to you. I want to start with your outlook for the upcoming year and pivot on the Fed decision today. We did, of course, get a rate increase. Some guidance, though, that looks as though there's not going to be as many rate increases next year, perhaps some concerns about economic growth. It looks like the Fed sees some headwinds moving ahead. What do you see?
Well, we certainly see the headwinds, and I think we can expect a lot more volatility, or let's say as much as we've been seeing. When you look at what drives markets, there are only three things that determine total return. You have growth in earnings, dividends, and growth in PE ratios. I think what people are underestimating is the importance of QT. For 5 years, in fact more than 5 years, we had QE at work, and QE was a godsend to valuation. And the best way to express that would be to kind of take a look at what the market did from, let's say, 2012 through 2016. And the S&P 500 actually doubled. But of those 98 percentage points, 67 came from multiple expansion. It was even more dramatic with the MSCI because that was up 87%, and 74 of those 87 percentage points were PE multiple expansion. So we just began QT. It's been underway in the U.S., it's starting again in Europe, and I think you're going to see an unwinding of that multiple expansion. So that will be a headwind. The multiple pressure will be a headwind as QT takes its effects. Now, when it comes to earnings, the earnings outlook should be good, but it's going to be less than people think, primarily because of the effect of the dissembling of supply chains, the end of the globalization growth rate that we've seen. And I think you'll see headwinds for profit margins. So the only way earnings are really going to grow next year, I think, are if revenues can grow faster than margin compression. So two of the three drivers of return, PEs and earnings, they're going to be under pressure. The good news is dividends are going to be fine. And a lot of that goes back to this idea that we have talked a lot about, that tech is the new macro. But when we speak of tech, we really mean the application of tech and its influence on profit margins and asset turnover. But I think you'll continue to see higher dividends next year, higher payout ratios, and share buybacks will continue at a high level, but probably not the level that it reached this year, which was a record.
I want to, we'll get into the technology and the tech is the new macro in the second part of our chat. I want to just dial back a bit too to talk about earnings. I mean, we have, QT obviously one of the biggest influencers on things. But what about trade? I mean, that's obviously, you mentioned the deassembling of the supply chain and what's going to happen. How bumpy do you think this is going to get over the next couple of years?
I think it's going to be pretty bumpy. No one wins a trade war. Contrary to what some well-known people say, trade wars are not easily winnable. What happens is it's lose-lose. We put a number of papers out on this topic, but essentially what happens is when you start to unwind trade that's been good, a win-win, it winds up being lose-lose. And you can see this. Profit margins in the United States for manufacturers have roughly doubled since 1989. It's quite amazing. For 30 or 40 years, margins were pretty much flat. Then they doubled from 1989 until recently. Remarkable. And when you look at what was behind that, there were really four things. There was the substantial rise in and the inclusion of people from China into our world. Essentially, there was a gigantic arbitrage. When the developing nations came into our world, principally China, they brought a lot of labor, but they didn't bring technology or capital. So we had the benefit of a giant labor arbitrage. While this was going on, we also developed incredibly sophisticated supply chains. And if you went back and looked at that era of 1989, we had higher tax rates and also higher interest rates. So three of those four things are going to go into reverse next year. The labor arbitrage game is over. Supply chains are under attack. Interest rates are likely to be a little higher than they are now, but tax rates will stay low. But all of that's going to put pressure on margins.
Let me ask you, I've only got about a minute left here, Bill, but politics. I mean, I know, people kind of look at tweets and see the market move, and I think much of this is really about the fundamentals of the market, as you mentioned, the QT and the earnings. But, we could have, with the Democrats in control of the House, some fundamental changes that could happen in Washington. So how much does that play out in the markets?
I think the anticipation is there'll be much revealed and there'll be much noise. But even if you were to if you were to think about the possible impeachment, there's the impeachment process, but then there's the conviction process, and I think that's almost impossible. So we'll have to see how that plays out. I think it's going to be a lot of noise, but I think it's going to be very, very difficult to have any change in the executive branch in the United States.
Bill, you mentioned technology is a new macro, and I want to get to that in just a second, but I just want to start with there's technology as a sector, and then there's technology as its influence in terms of what's happening with the markets overall. Just as a sector, we've seen a fairly significant sell-off. I think that would be a kind way to say it, helping lead these markets down. Is that just, again, a QT or a liquidity issue happening in the markets right now?
No, I think, well, you're onto something, Kim. I think we had a very large position in many of our portfolios in tech, which we unwound substantially but not completely in the first part of 2018. The key to that, what triggered that unwind was to some extent China and the 2025 importance. So when they laid out their 10 sectors that they want to dominate, you can't dominate those things without using U.S. technology and particularly the semiconductor expertise. As the combination of Vice President Pence's speech, which I think everyone should read because that to me is a very important document, and the trade issues that the trade war, it really hurt semiconductor industries and tech very badly. Now, at some point, that will be washed out. Maybe in the first quarter of next year, valuations have come down quite a bit. But there's no question that when you talk to these companies, expectations for orders and earnings, they've been cut back quite a bit, even as recently as the insight given the other day by one of the leading semiconductor manufacturers. So that to me is you're going to enter a period where valuation looks good, but you're still going to have earnings indications that I think will be reduced as you go into the end of the year and first quarter. Guidance will likely be kind of negative for many tech names.
Okay, and now let's talk. I think this is important because, again, it's fundamental, I think, to how you see the markets. You talk about technology as the new macro. Can you just spend a little time talking about what that means? We've got a chart here, which might be a little confusing for people to look at, but if we bring it up, I'm going to paraphrase a little bit here. I think the thesis is that technology makes all the things that go into return on equity a little more efficient almost.
Correct. And the way to think about it, just imagine if you were running a business and you hire 100 people to work in your store, and suddenly you find out that you can put in a technology base and you don't need those 100 people and you can still keep your revenues. Well, if you can substitute technology for people, think of it being labor, your profit margins are going to go up. The same thing is true if you decide, hey, I can sell things over the internet as well as I can through a physical store. Maybe I should rebalance my selling space and have more over the internet, in which case you don't have to have all that bricks and mortar, so you can substitute technology for bricks and mortar. At that point, if you think about it, you now have higher profits and lower physical assets. So your return on assets have gone up a lot with the introduction of technology. Now there's a third ratio there called assets per dollar of equity. That's the amount of leverage in your business. Well, if you don't need the assets, you don't need all that capital in your business. And the good news is you can take capital out of your business, and you'll do that through higher dividends, higher payout ratios. And that'll be very positive for a number of stocks that basically rely on dividend payments and increasing dividend payments. The way to think about that, too, is the digital economy is very deflationary. Now, we're starting to see inflation get into wages, but in many cases, it's offset by the substitution of technology for labor. And you can see it if you compare the consumer price index to something called the digital price index. There are a number of industries where the DPI is far below the CPI. That's going to put a lid on inflation. And it may also wind up not being quite the increased force on interest rates as you go through next year. We might be surprised that interest rates may go up, but they may go up a lot less than people think. A lot of that will be due to the impact of technology and its substitutability for labor and physical assets.
I think, and you and I have talked about this before, the long-term implications of that are significant. We're not going to solve that in this conversation right now. Again, I've got about a minute left, Bill, but I want to ask you, QT, supply chain disruption, technology, the new macro, China 2025, what else should be watching for next year? What do you see happening with the markets?
I think when you look at the geopolitical situation, it's a huge issue. The rise of populism, whether it's in Europe, you can kind of see Europe start to come apart a bit. It's very disconcerting. The post-war order that we've had since the end of World War II, led by the U.S. and arguably the European Union, much of this is coming to end. And the real question is, can democracy survive? And history would suggest that democracy works if the standard of living is increasing. When standard of livings are not increasing, it may be difficult to have some of our democratic models hold together.
And what is going to be the impact of, I mean, that's huge. What does that mean, though, for how does that translate into market activity, do you think, for 2019?
I think as a bias, you want to be local. The U.S. is still going to fare better than most of its trading partners. So if you don't want to go global, you need to go local. So think about, again, getting back to retail. In the U.S., we will be fully employed. Wages will be going up. The low-price retail stores like Dollar General, for example, should do relatively well. You may question the valuation there, but I think you want to try and invest local. There'll be some global champions, no matter where they are, they'll do well. You can think of some of the aerospace companies. But in general, I think next year will be a struggle.
Bill, great insight as always. Tough conversation, but good to talk with you. Have a great holiday.
You too, Kim. Thank you very much.